The S&P 500 has just emerged into what appears to be a new uptrend. It's above its resistance lines. It is showing that it wants to get above the 3,000 mark and begin rising in earnest from here. We want to go back and look at or review the prior posts that we've done and videos on the S&P 500 and the current conditions and see whether or not the S&P 500 has the legs to be able to go into an important confirmed uptrend from here. So this is going to be a review of the last few months of material, and then we're going to look at some stocks that might be appropriate for investment for the environment ahead. Then changing gears, we're going to do an impeachment analog. And so we're going to look at this subject of impeachment and from a non-political perspective and see whether or not there's anything here that we should be concerned about. So let's get to work. Welcome to Power Charting. I'm Bruce Fraser, your host. Thank you for being here. First of all, I just did an IBD podcast, first one I've ever done, with Arusha Perez, the host at the investing podcast that they do. And thank you, Arusha, for having me. It was a lot of fun. It's a little difficult to speak without charts, so that was very interesting. And you can go listen to this podcast by going to investors.com, then look for videos at the top of the page. Under videos, you'll see investing podcast. And then also you could go through, I believe, your regular podcast app that you have also to listen to that. So with that, thank you, Arusha. Today's agenda: can the markets trend higher from here, which we just introduced, the economics of impeachment, and then 3 stock profiles. So this is going to be a lot to cover in this session, but we're going to get it done. So we did a recent, in July, we did a recent video and also a blog on the third turning. And what we're talking about here really is 3 consolidation areas that we've had in this epic bull run that we've been in. And each of these pauses in the ongoing uptrend has really set the conditions through our Wyckofian orientation of being able to pause, build a cause, and then go into another important uptrend. And so we're asking the question, is this pause a precondition for another important uptrend? And so we have in the third turning analysis, we could see that there's generally been a lot of similarities. We've had similar GDP. GDP has been getting a little stronger throughout the uptrend. We've had unemployment rate dropping during each one of these, and now it's quite low. And we have generally stable inflation at a very low level. And so we have done the analysis of considering the reaccumulation area of each one of these, which we've covered in prior blogs. And then we looked at the most recent one. So let's do that now. Now, let me just make this point that we now are at 21 to 22 months of consolidation in this current trading range, which puts us approximately at the same duration of the prior 2. And so if timing is important here, it could very well be that we have completed the 21, 22 month time window just in time to start a new uptrend. Okay, so this is the chart from that July 8th post, but we have brought it up to date. And you can see here that this just excruciatingly long reaccumulation type structure, which is what we're viewing it as, has all the Wyckofian elements of a buying climax, automatic reaction, up thrusts in the middle part of the range, of the duration of the range. And then there's this big shakeout, which came at the December lows of 2018. And then notice what happened after that. We had this just moonshot advance, which showed that there was a combination of two things. One, tremendous demand and a lack of supply. And so this was just produced week after week after week of important rising conditions. And then each one of these reactions, and this is classic Wyckofian analysis, each one of these reactions has really been diminished from the prior reaction. And so we've had here diminishing volatility, and diminishing volatility is a measure of the completion of absorption. And so we have potentially here an accumulation that has been fully absorbed going back 22 months and is now in a position to start a new rising trend. So this is this is the important question that we're asking. So with this in mind, let's move on to the next chart, which is a point and figure chart of this area. And so you can see here's the second turning right here. Second turning produced an important point and figure count objective, which actually goes higher than the area that we have. This green area counts up to 2960, 3140. Well, we got to the 2960 area as we ran up, and this did stop the advance, and it stopped it quite dramatically. Then we have, so we have higher prices if we add this blue phase over here, which takes us 3,800 to 3,980. We've done other really large point and figure count analysis in the past, and people have said there's no way the market can get to those levels. And the point and figure analysis did a wonderful job of getting the market or confirming the uptrend, and the market did get to these point and figure objectives. So now we have just the yellow area of this 22-month accumulation that we've been in. We can say gives us a run to 3620 to 4,000. Substantial upside potential here for an important uptrend. Very exciting. But also keep in mind that if we add the second segment here, what we're calling segment D, we can see that this takes us to 5,060 to 5,440. So this is a very large upside potential, and we want to keep both of these objectives in mind, especially if the market can, and in this case the S&P, but the Dow and the NASDAQ should follow, can work their way up from here. There is a substantial potential ahead of us. And so this should be informing our tactics. Okay, now I want to show you that I took this count. This was a July chart. So this, we had a jump up and out and a back up, and then we took this count along here. This is still, I believe, the count that we want to focus on, which is right here. And so this chart is up to date through October 31st. And so you can see here that look what's happened. We've had a jump up and out, and we've had a backup. This backup produced its own small count here, and so this count takes us up to around 3260, which is a swing trading count. We would just count from here to here. And so this is very compelling, and notice that we are above 3,000 right now. Very important place, because this is the place where markets can fail. They get to marginal new highs and then they just turn tail and come back into their trading area. And so we're watching this very closely, but we have a swing trading count that goes up to a nice level. And then we have this very large campaign count that takes us up to much higher levels, which we just reviewed. With that, let's now review why the S&P 500 could have this good upside run. And here we are looking at the US Treasury 20-year yield. So this is the decline, the secular decline of Treasury yields using the 20-year as our benchmark. And then the red line is the S&P 500 yield. So the at the 2009 bear market low, we had a very interesting event happen. You can see there's this huge yawning gap between these two data series here. But notice this, they touched. So the US Treasury yield collapsed and the yield on the S&P 500 went way up because stock prices were so low, and they crossed. And this produced an interesting value proposition because you were able to buy the S&P 500 with a yield that was exceeding the yield of US Treasury bonds, 20-year. And so this created a value proposition. Well, this is the first time this happened back in 2008, 2009. Then the three turnings that we just evaluated, to keep those in mind, because that's what this is. This is the three turnings that we have. And so here you can see that we've gone down and touched the S&P 500 yield to the US Treasury yield here, and it produced two things. One is it produced a big uptrend in stocks, and it also produced a rise in Treasury yields, which was a mini bear market. So that was two things that were quite important to investors: buy stocks, sell bonds. So here we have at this next turning, we'll call this the second turning right here, we can see that there was again a cross where rates came way down, went below the S&P 500, and then we had two things happen. We had a big uptrend in stocks take place, and we had a bear market in treasuries that went on for quite a while, about 2 years. And so now look what's happened is treasury yields have collapsed again. They've gone below the S&P 500 yield, which now makes the S&P 500 attractive or a relative bargain to bonds. And we have the completion in this of the third turning, which we would argue gives the conditions to buy stocks and sell treasuries. Now, keep in mind that most of the bonds in the world are at negative interest rates right now. So there are about $10 trillion more of market capitalization in the bond market than there is in the stock market. So just the slightest migration of money away from bonds towards yielding stocks could have a huge bullish demand for the stock market and then unleash a new uptrend. So this is a real value proposition that the market is considering at this time. So I believe that the other thing that could happen now here is just to bring this data current. So this is as of a day or so ago. You can see that the treasury yields are starting to rise, which is starting to soften bond prices as we had said at the time. And look at how the S&P 500 is starting to move away from its consolidation zone, its reaccumulation area, or the third turning is beginning. Okay, with that in mind, let's talk about what stocks to consider. Now, this downtrend is a relative strength line of the S&P 500 dividend aristocrats These are very high quality dividend stocks in the S&P 500 in relationship to the internet index, which is just a proxy for growth stocks. So we're looking at growth stocks and we're looking at income stocks. And so doing a relative strength ratio here, we're able to see that when the line is dropping, this trend channel is dropping, that this is favorable for growth stocks. Growth stocks are leading the way, they're outperforming. Look what happened right at the end is that you had a throw under of the channel and then an important rally that occurred that was favoring income over growth. And so this set the boundaries of a new trading range here. Now we've had a test of this area, and again, we're having a rally. We're making the suggestion here that income stocks are going to have favorable treatment or favorable interest by institutions and large investors over growth stocks. That doesn't mean growth stocks have to not do well. They can perform quite well, but that the income stocks are going to be of great interest in the market going forward. So, and I'm going to tell you about a new newsletter, market selection newsletter that I'm doing with Mary Ellen McGonigal, where we're going to focus on growth stocks that have income and looking for total return, but with an emphasis on appreciation or growth. So here, these two charts you can look at on your own. You can go to the blog and see these, but notice that the dividend aristocrats are in a confirmed uptrend. They're acting quite well, and the relative strength is quite good and has been for a while now. So there's dominance of interest moving towards income producing stocks. Here are the growth stocks, and you can see that they're generally waning here. This chart's a day or two old, and you can see the relative strength is declining. And so that doesn't mean that growth stocks aren't going to do well. It just means that the interest is going towards income, and it would be ironic if the income stocks outperform the growth stocks going forward for a while at least. So the last thing I want to show you here is the potential appreciation that we have in the dividend aristocrats using classic point figure analysis across here. It gives us from the current levels as of the production of this chart, which was around October 20th, it gives us a 26% potential appreciation upside from the objectives of this point figure analysis, and takes us up to 90 to 95 from the current level of around 71, 72, and I think it's up a little bit from there. But that would suggest that the S&P 500 is going to have performance that's very similar to that. So that's a significant move upward, and there may be additional point and figure count objectives that are created along the way. So there is upside potential in the point and figure, and currently the index is moving up and out of the consolidation area where this count was taken. So the uptrend appears to be in force. Now let's get to this analog of the economics of impeachment. This is, I think, an interesting time. As of today, when I'm recording this, there has been an impeachment vote in the House to move forward the impeachment of the Trump administration of President Trump. And so we have no idea what could happen here, what the politics hold. I want this discussion to be about the economics and the tactics, about what could happen in an unfolding impeachment exercise. I don't want it to be political. This is not for us the important question. The important question for us is, what do we do if these impeachment issues start to weigh on the economy, the stock market, the indexes. And so we want to be prepared and have some kind of a checklist or an understanding of how things can unfold. And my preference, if I had any preference at all, is that I don't want anybody messing with the economy, as if I had a vote, right? I don't have a vote. So the economy's doing great. People are employed. They're earning more money. I'm really happy about those things. And I would love to see the stock market continue to have a robust continuation of its uptrend. And that's what I expect to see happen based on what we've just discussed. But also we have to be realists, and we have to understand that this could be a real political issue that could work its way over into the economy as it exists right now. So looking at this, we can see here a classic Wyckofffian distribution structure. And so this distribution structure has a buying climax. Well, let me tell you, first of all, I'm getting ahead of myself. And that is, this is 1970 to 75. This is the time or the period of the Nixon impeachment inquiry. We know that Richard Nixon ultimately was not impeached because he resigned, but he was told at the time prior to his resignation that there was going to be an impeachment exercise, and that the Republicans informed him that he was likely to be impeached and convicted. And so his decision was to resign ahead of all that. So with that in mind, so we can see here that there's a buying climax, an automatic reaction that sets a range-bound condition, resistance, support. We can see that about a year later, there's a sharp decline and then a rally up. Now, what's different now than to now is that this was all going into the re-election of Richard Nixon, which he won re-election by a 49 state landslide. And so the market worked its way up into the November election. So here's election day. And you can see that it pushed up to an all-time new high, looking at the Dow Jones, and had an upthrust where it pushed up in an exhaustion move to a final new high above the resistance area. But what we know about resistance is that the markets can get above it, but they also will exhaust themselves and fall back in again. So this is what we're going to want to be on the lookout for currently, is the market's ability to be able to continue to stay above and mark up past the resistance line that was set in January of 2018. And so here we can see that there's a decline back into the structure of the trading range, and look at all the volatility in here. The volatility is very high as it's going lower and lower. Volume is generally high throughout this decline. And notice also that this came right on the end of the year. So right at the end of the year, right after the election, a month after the election, was the final high in the market. This decline was the worst inflation-adjusted decline in the market since 1929. It was a terrible loss of wealth for the nation and for the world. And so then you can see that after a minor sign of weakness that takes out these key prior lows, there's another rally into a last point of supply, which can get up to and slightly through resistance, but only briefly. And then there is tremendous weakness after that, all the way down to support, which produces a major sign of weakness. It's classic Wyckoff, classic distribution. And so you can see tremendous supply coming in and ease of movement in these declines. Then look at this rally attempt. This rally attempt is of very poor quality, much overlap, very little ability to just mark up. And this produces another last point of supply, which is in the area of what we would call the ice. So there's two levels of ice here. There is a decline that takes place off of this LPSY, goes back to support, hovers around here. This is the second form of ice, which is right at the support area, and then the market just collapses. The Nixon resignation occurred 6 weeks before the low. So all of this was taking place about a year and a half of decline off the peak. Well, this is 1, 2, 3 years. So let's see, 1 year, 2 years, 3 years right here into the last point of supply. So it took 36 months for this drama to unfold. In this particular case, the thing that we would want to look for is to look for a failure back into the trading range. So if there's a failure as this impeachment exercise is occurring back into the trading range, then that would be, I think, a very ominous sign. And then the inability to be able to rally up through the resistance area produces the conditions for completing distribution. And so the only other thing I want to point out, so that we can use this as a potential analog, we're going to do the Clinton impeachment here in the near future. So we want to look at both of them because the Clinton impeachment is very different from the Nixon impeachment. And here you can see that the Fed funds rate was going up dramatically all through this, which could be a sign that the people are looking at the bond market and the tumultuousness of impeachment as being not good for the economy or for the bond market. So I'm not predicting this, but this is something that we would add to our checklist of conditions that we would consider a warning, would be rising interest rates. So we don't want this to happen. We're not expecting it to happen, but this does give us an analog that we can work with and have at our beck and call in case we start to see a change in the way that the market is behaving here. Okay, moving on. So here is an example. Oh, first of all, if you're interested in this newsletter, this is the first time I've ever done a stock newsletter where I've taken all the stock work that I do week in and week out, and I'm going to produce that stock work with point and figure analysis on what I consider to be the very best ideas, and also with Mary Ellen's very best ideas. And we're going to do this work together. And so here is just an example of the kind of stocks we'd be looking for. Here you can see Polaris has a 2.45 yield. It has a beautiful accumulation structure. It's pivoting up and out. You can see that there's a downtrend, beautiful pivot on volume up out of the resistance area. Well, look here. This is that 130 area. And so we can see that 122, 130 is the count area potential. And then there's also the 176, 184 level in the second segment. And here's the third segment, which will count later on once we achieve the first. Here's PPG. You can see here, beautiful reaccumulation structure, sign of strength. It's already marking up and out. It's got a yield of 155. And here are two segments that we can consider. One goes to 180 to 193 from around 125, and 269, 289 for the second segment. So a lot of upside potential, and this is one that's just getting on its way. Let's expect all good things from the market here. There's lots to like about how the market is behaving at this time. And let's just keep that impeachment analog in our back pockets so that if there are problems out there, we have a way to be able to identify the conditions that we should be worried about. Thanks so much for joining us.